Okay, let's unpack this because I want you to imagine a marathon runner, right? And they cross the finish line and just completely collapse. Like they are physically down on the ground, they're broken, they just cannot take another step.
Right.
But you look at their heart rate monitor and it shows they actually have this like massive reserve of energy left. And that impossible contradiction, that is exactly what the Pakistan Stock Exchange did on August 27th, 2026. Because we have this fresh stack of technical charts today, price actions, momentum indicators. And our mission for this deep dive is to basically decode that exact paradox.
Yeah, it is a paradox because, well, on the surface, the broader market at close looking just completely exhausted.
Right.
But if you look beneath that surface, the data is telling an entirely different story. I mean, the broader index, the KSE-100, it gives us the perfect starting point to understand this.
Yeah, set the scene for us. Like, what did the surface level actually look like?
So if you just look at the surface level data, the index closed virtually flat. I mean, right around the 322 mark.
Right.
Barely down,
Yeah.
like negative 0.03%.
Right, so basically flat.
Exactly, basically flat. But the intraday price action that tells a story of really intense afternoon fatigue. So we saw a peak early in the day near 178,600 or so. And that was followed by just a methodical, steady bleed downward. And the final 4-hour candle for the day was a strong bearish candle closing right at the absolute daily lows. So immediate support is basically hanging by a thread right there at that 177,200 level.
Okay, so if I'm a trader, right, and I'm watching that close, I'm probably going home thinking like, oh man, the floor is just falling out.
Oh, absolutely, yeah.
But this is where I need to unpack that marathon runner analogy, because the momentum indicator, specifically the 4-hour stochastic RSI, it actually executed a bullish crossover right as the price was collapsing.
Yeah.
Like the fast-moving line, the percent K, it crossed above 53.95, leaving the slower-moving average, the percent D, lagging down at like 38.59. So I kind of have to challenge this right out of the gate, because if the final candle of the day is a strongly bearish candle closing at the absolute lows with all this heady selling pressure, isn't that undeniably terrible?
Well,
Like, why should anyone trust some hidden momentum metric over the reality of the actual price action?
right. So you have to separate the destination from the speed of travel.
Okay.
So price action tells you what has already happened, right? The runner collapsed, the price went down.
Right.
But momentum indicators like the stochastic RSI, they measure the velocity of those price changes. So when you have an asset bottoming out in the oversold zone, which on this specific chart is below 20, and then it executes a bullish crossover while the price is still dropping, well, it mathematically indicates that the downward velocity is running out of steam.
Oh, I see. So the price is still going down, but the physical force that's pushing it down is kind of evaporating.
Correct. Exactly. The selling pressure is exhausting itself. It's a leading indicator.
Wow.
So the index might be resting at the daily lows, but the conditions that drove it there, they're fundamentally shifting.
So what does that mean for the next move then?
It suggests the next probable move is a recovery attempt back toward immediate resistance. Likely targeting that 178,200 level, or eventually the heavier overhead resistance zone up around 181,000, where the market topped out earlier in the month.
Okay, well, here's where it gets really interesting. Because if the broader index is kind of masking this underlying exhaustion, then I think it makes sense to look at the specific equities that are taking the worst of the beating.
Yeah, absolutely.
Right.
Let's look at what seller exhaustion looks like up close.
Right, because we want to see if they're forming a bottom. And Pakistan State Oil PSO is just a glaring example of this. So it closed down in the 363.45 range.
Yeah.
But the stochastic RSI is flashing literally a 0.00 on the fast line.
It's incredible.
And the slower line is hovering just below 10. It's at like 9.83. So when an indicator flatlines at pure zero, I mean, is that just a dead asset? It feels like hitting terminal velocity, right? You're falling, but physics dictates you literally cannot accelerate downward any faster.
Terminal velocity is a much more accurate way to look at it than just assuming the asset is dead.
Okay.
Because to understand a zero reading, you have to look at how the formula actually works.
Right, because it's math.
Exactly. The stochastic RSI measures the current closing price relative to its high-low range over a very specific historical window. So for PSO to print a 0.000, It means the stock closed at the absolute lowest fraction of its recent look-back period.
Oh, wow.
The selling pressure has pushed it to an absolute mathematical extreme.
Like a squeezed lemon, right? There's mathematically just no juice left to squeeze out of the sellers.
Exactly.
But just because it hits a mathematical extreme doesn't mean it automatically bounces, right? I mean, it can stay at zero.
Right. It doesn't mean the price can't drop further. But it does mean the downward momentum has zero room left to expand on this specific time frame.
Got it.
And crucially, PSO is resting right near key structural support around 359 with a deeper safety net in the low 350s.
Okay, and PSO isn't the only one experiencing this terminal velocity. Like we have National Refinery Limited, NRL, and that closed near 478.99. It's testing this major ascending orange trend line support. And its indicator is also basically zero, right? Like percent K is 0.99%, D is 1.04. And then there's TPL Corp, resting perfectly on a horizontal support line near 21.75. Its momentum is totally flatlined around 5.63. So if you're a listener, right, and you're holding one of these stocks, you see the price bleeding out.
Yeah.
But you also see this flatline momentum right at major support levels. So my question is, does a flat line at support act like a coiled spring, or does it just mean the buyers have completely abandoned ship?
It points heavily toward the coiled spring scenario.
Yeah.
And specifically because of where the price is sitting.
Okay.
Because context is everything in technical analysis, right? If NRL was just in free fall with no historical support anywhere nearby,
Yeah.
a zero reading would just indicate extreme weakness.
Right, it's just falling into the void.
Exactly. But NRL is sitting right on a critical ascending trend line. TPL is sitting precisely on a long-term horizontal support base.
Oh, okay.
So when momentum flatlines exactly where buyers have historically stepped in, it tells you the sellers have thrown their heaviest punches right at the most fortified defensive line.
So they're out of energy right at the wall.
Exactly. So if NRL holds here, you're looking at a quick upside target of 500.
Oh, wow. Okay. Well, then we have Gandhara Tire and Rubber GTYR. And this gives us a look at what happens immediately after that coiled spring starts to actually move. Because it suffered this brutal gap-down sell-off, right, plunging from the 32 area down to 29.05.
Yeah, that was a nasty drop.
But it's holding support around 28.74. And unlike PSO or NRL, its momentum isn't flatlined at zero. It's actually showing an early bullish crossover while still deep in oversold territory. The fast line is climbing toward 13.97, crossing the slower moving average at 8.05.
So let's talk about the mechanics of a gap down for a second.
Yeah.
Because a gap down is usually pure panic, right?
Oh, yeah. A gap down is the literal visual representation of overnight panic. Okay.
It means the opening price was so much lower than the previous day's close that no trading happened in between those two prices.
Right. Just a blank space on the chart.
It is a vacuum. Exactly. So GTYR absorbed a massive shock to fall down to 29. But that early bullish crossover, that is the first mechanical whisper that the panic is actually stabilized.
Wow.
The sellers dunked their inventory, driving the price down. But the momentum of that selling has already peaked and reversed.
So the immediate hemorrhage has essentially stopped.
Yes. But you have to remember, recovering from a gap down is notoriously difficult because it leaves all this overhead resistance.
Right, all those people trapped above.
Exactly. If that stabilization holds, GTYR has to fight through really heavy resistance to fill that gap back up. First at 31 and then closer to 33.
Yeah.
But looking across these four, right, NRL, TPL, and GTYR, where you're seeing the distinct life cycle of seller exhaustion.
Yeah.
Extreme pressure flatlining at support, and then the first sparks of a reversal.
Man, that is fascinating. Which brings up a really interesting pivot, I think. Because we just looked at stocks scraping the absolute bottom.
Right.
But if we shift our focus, there is a whole different class of equities that they didn't panic at all during the afternoon market bleed.
Yeah, the holders.
Yeah, the holders, exactly. The stocks methodically surfing their technical channels. Let's look at those. So Pakistan Telecommunication, PTC, it closed slightly green right around 70.02. And it's perfectly holding the lower boundary of this solid orange ascending channel.
Mm-hmm.
And then TPL Properties, TPLP, closed near 14.59, sitting directly on horizontal support, just kind of consolidating sideways with its RSI hovering near oversold. But it's certainly not in distress like the others.
Right, and in an environment where the broader index is dragging basically everything down, stocks that respect their structural boundaries, they are telegraphing quiet accumulation.
Oh, okay.
So PTC, holding that lower channel zone, is highly significant. It isn't flashing the extreme distress of a zero RSI. It's just exhibiting solid structural stability. So if that channel floor holds, The geometry of the chart actually projects a major resistance target up near 75.
Oh, wow. So just by doing nothing wrong, it looks really strong.
Exactly.
And this idea of structural stability, it sets us up perfectly for what I think is easily the most fascinating divergence in this entire stack of data today.
Let me guess, the cement sector.
The cement sector, exactly. The great cement divergence. Because we have these three massive companies operating in the exact same macroeconomic environment, right? Same interest rates, same construction demand, same energy costs, yet their 4-hour charts look like they exist in completely different realities.
It's striking.
So let's unpack Lucky Cement LUCK first. It closed down slightly at 440.50, but it's resting directly on a long-term orange ascending trend line. And despite the red close, its stochastic RSI is surging. Like the fast line is up near 87.05, executing a bullish crossover above the D line at 72.70.
So what you're seeing there, Lucky Cement, is demonstrating really intense underlying strength.
Okay.
You have price consolidating on long-term structural support, but the momentum is rising sharply.
Right.
That is the footprint of buyers stepping in aggressively to defend that trend line. It is a textbook setup for a bounce toward its resistance zones, probably in the 450 to 456 range.
Okay, so that's Lucky. Bouncing off a trampoline, basically.
Yeah.
Now compare that to Maple Leaf Cement MLCF.
Oh.
It closed down near 102.3. Well, unlike Lucky, which is bouncing off a floor, Maple Leaf is consolidating near the top of its technical indicators.
Right.
Like its stochastic RSI is highly overbought, with both lines pinned way up in the 90s, right? K is 92.25, D is 94.45.
Right, they're in completely different phases of their technical cycles. So Maple Leaf is riding the middle of its own ascending channel. But because the momentum indicators are pinned near the top, it implies that buyers have been in absolute control recently.
Yeah.
But the rubber band might be getting a little bit stretched up there. So they're consolidating gains, just kind of staring down immediate overhead resistance near 104.
Okay, so we have Lucky bouncing off support with rising momentum and Maple Leaf stretched at the top. But then we have DGKC, DGKC, and honestly, if you're holding this one, you're probably staring at the chart just feeling a bit terrified.
Oh yeah, absolutely.
Because it closed down near 215.35. It completely failed to hold its support. It breached a major orange ascending trend line to the downside, and its momentum is showing a bearish crossover, literally falling out of the overbought region. So let's talk about the mechanics of a trend line break. Why does a stock suddenly accelerate downward when it crosses one of these invisible lines?
It comes down to liquidity and algorithmic triggers, basically.
Okay.
Because a long-term trend line isn't just a line drawn on a screen, right? It represents a cluster of actual historical orders.
Right, where people agreed to buy in the past.
Exactly. So when DGKC was holding above that line, buyers were stepping in because they perceived value. But when the price breaks below it, two things happen, basically simultaneously.
Okay, what's it first?
First, the buyers just disappear because the structural integrity is broken, the thesis for buying is gone.
Right.
And second, a cascade of automated stop-loss orders gets triggered
Oh, man.
because traders who bought near the trend line, they usually have protective sell orders placed just below it,
Yeah.
right, just in case.
Yeah, that makes sense.
So when the price hits those levels, it triggers all those orders and floods the market with sell orders, violently accelerating the drop.
So it's basically a self-fulfilling prophecy.
Very much so.
The breakdown triggers the selling, which just causes a deeper breakdown.
Exactly.
But this leads me to a massive question. If a major sector leader like DGKC breaks its structural floorboards and triggers the stop-loss cascade, shouldn't that fear infect the rest of the sector?
You would think so.
Yeah.
Right? Like, does a breakdown in one major stock usually drag the rest down, or does this just prove it's entirely a stock picker's market? Like, why is Lucky Cement surging in momentum while DGKC is breaking down?
That is the golden question. So a breakdown in a major player, it can cause a brief sort of reactive sentiment shock across the sector.
Okay.
Like retail traders might panic and just sell everything cement related because they see DGKC falling.
Right, just get me out.
Right, get me out. But institutional capital and sophisticated trading algorithms, they don't trade based on sympathy. They trade based on specific chart structures.
Oh.
So if DGKC breaks support, that previous support now flips and acts as a ceiling of overhead resistance near 220.
Oh, wow.
Capital's ruthless. When institutions see DGKC's structural integrity fail, they put their money out,
Right.
but they don't necessarily leave the sector right. They rotate that capital into the strongest remaining asset, which in this case is Lucky Cement.
Oh, my gosh.
So the divergence you're seeing, it isn't random. It is the literal footprint of large capital migrating from a broken chart to an intact one.
That is incredibly revealing. It's like capital fleeing a burning building, but instead of leaving the neighborhood entirely, they just move into the fortress next door.
That's a great way to put it, yeah.
Wow. Okay, well, speaking of capital moving into a fortress, we need to talk about the absolute outlier in today's deep dive.
Let's do it.
Because we've seen exhausted sellers right at terminal velocity, and we've seen capital rotating within a sector. But what does actual, undeniable, new, aggressive buying look like when the broader market is bleeding?
Right.
Enter Pakistan International Container Terminal, PICT. Yeah, it closed at its absolute session high of 47.44, up over 1.52%. It established this concrete local bottom above major supports in the 36 to 39 range, and the momentum indicator confirms this strong, bullish crossover blasting out of the oversold zone. Like the fast line is surging past 62.75, crossing the D line at 36.44. When you stack PICT's strength next to the KSE-100's weakness, it really begs a much bigger question about what is actually happening here.
What's fascinating here is what you are looking at is the purest definition of relative strength.
Okay.
And to be clear, in technical analysis, relative strength isn't just an indicator like the RSI. It is the observable behavior of an asset completely decoupling from its macroeconomic environment.
Wow.
On August 27th, the psychological weight of the KSE-100 was pulling the entire market downward. But PICT didn't just survive that gravity, it actively advanced against it, closing on its absolute highs.
Right. I want to dig into how that happens, because if you picture this this torrential, gloomy rainstorm, right, where everyone on the street is huddled under awnings looking miserable, PICT is the one person casually walking down the sidewalk in a bright yellow raincoat with a massive smile on their face.
Right, exactly.
Like, what mechanism allows a stock to completely ignore market gravity like that?
It requires a level of buying conviction that simply overpowers retail fear.
Okay.
So when a stock exhibits this kind of relative strength on a red day for the broader index, it usually points to institutional accumulation.
Why institutions specifically?
Because retail traders are generally risk-averse. Right? If the KSE-100 is dropping, retail traders aren't out aggressively buying breakouts.
Where they're hiding under the awning.
Exactly. So when a stock pushes to its session highs against the grain, you are seeing larger entities, funds, algorithms, or institutions acting on maybe fundamental catalysts, and they are stepping in and absorbing every single share the retail market throws at them.
Wow, so they're actively buying the fear.
They are buying the supply, yes. And technically, because PICT has established that strong local bottom and the momentum is surging through the midpoint, it isn't fighting to survive anymore.
Yeah.
It actually has a remarkably clear runway toward its primary overhead resistance target near 51.55. It is honestly the cleanest chart in this stack because all the structural work is already done.
That is just wild. We have covered a massive amount of ground today.
We really have.
I mean, from the broader index kind of masking its own momentum to the beaten down refiners hit in a mathematical terminal velocity, right, the squeezed lemons. We've mapped out how capital ruthlessly rotates away from broken trend lines in the cement sector, and we've identified those institutional footprints driving PICT against the market current.
Yeah.
So how do we sort of synthesize all of this data into a coherent outlook for the listener?
Well, the unifying thread across this entire stack of 10 equities in the KSE-100 is that you simply cannot evaluate this market on price action alone. August 27th looked exhausting. If a trader only looked at the red numbers and the heavy bearish daily closes, the logical assumption is that the market is prepping for a deeper collapse.
Right, the runner is dead on the track.
Exactly.
Yeah.
But when you look at the mechanics beneath the surface, the 4-hour stochastic RSIs, they're flashing a coordinated signal of seller exhaustion, almost entirely green. The downward velocity has spent its energy.
Wow.
From the broader index's bullish crossover to PSO resting at mathematical zero to the intact structural supports of the channel surfers, the market absorbed a very heavy blow, but the underlying framework is holding firm. It's basically preparing for the next rotation.
It's a market that looks fatigued on the surface, but has this racing, coiled heartbeat underneath.
Very well said.
Which brings me to a final thought, and this is something I really want everyone listening to kind of mull over before the opening bell rings tomorrow. Because we just spent this entire deep dive uncovering how 4-hour charts reveal these mathematically hidden momentum shifts right at the close. We can see clearly that the sellers are exhausted, but we are definitely not the only ones analyzing this data.
Oh, definitely not.
So if these specific metrics are flashing oversold and printing bullish crossovers at the closing bell, How much of the next morning's opening price action is already predetermined? I mean, there are thousands of algorithmic trading bots instantly digesting these exact momentum metrics, queuing up buy orders before human traders even pour their morning coffee.
Yeah, that's the reality of it.
So what does this all mean? Does human sentiment even matter at the open? Or are we just watching the bots execute a mathematical bounce that was effectively guaranteed the night before?
It's a great question.
Keep an eye on that opening volume. Until next time, keep digging beneath the surface.